Right, so this is our end of term revision, and we're gonna be doing that. We're gonna do our revision by using past paper questions on in different topic areas, the topics that you would have covered throughout the Form 4. So one of the first ones you're looking at here is ratio analysis. Everybody did ratio analysis. So I have the question, and what I did is I took a little snippet of all the ratios and included it here as well. So even though the question is not looking at all of these ratios, you still have your ratio formulas at a glance on my right-hand side here. Yeah? All right, so let's talk about Floral Blooms. Floral Blooms is planning to invest in another business and is presented with the data for its consideration for two similar businesses which operated in the same financial period. Table 1 shows the balances for the two businesses. We have Periwinkle Inc. and we have let's look at Veneer Limited. So we have revenue, gross profit, expenses, capital, closing inventory, accounts receivable, the bank account, and accounts payable. Calculate the following ratios to each business: return on gross profit and return on investment. So this is the answer sheet that they are available in the past paper. So you have gross profit, and they want us to put the formula. Our formula for gross profit is gross profit over sales by 100. All right, so let's write in that. Gross profit over sales multiplied by 100. The fact that we multiply by 100 means that our answer is going to be in percentage. Right? So Periwinkle gross profit was right here 20,000, and the Veneer was 24,000. So we're doing 20,000 over sales, which is the same as revenue. 80,000 for Periwinkle. So you could go ahead and calculate this as I write them up here, and you can tell me what to get. On this side, we have 24,000 over 85,000 multiplied by 100.
So I could just, I know we're already started, but I think by chance I could just be excused to get older.
Yeah, sure, of course, no problem. Sophia. Right, so we're looking at
What are we doing?
we're looking at this question here. We're doing revision by using past paper questions, touching on the different topic areas that you would have covered throughout Form 4. The first question here is a question that is based on ratio analysis. We have the balances here for two companies that Floral Blooms is interested or they're planning to invest in another business, and they are presented with the data for its consideration of for two similar businesses which operated in the same financial period. There's Periwinkle Inc. and this is Veneer Limited. Looks like a ED, or Vinca Limited. The question is asking us to calculate the ratios for each business. The first is the gross profit, and the second is return on investment. On our right-hand side here, I've included a snapshot of the different types of ratios that we have available to us, right? It includes all of the ratios that you need to be aware of. So we're doing the gross profit ratio. This is the actual question sheet from the past paper. The question sheet is asking us for the formula. So I wrote the formula here. This is gross profit over sales multiplied by 100. For Periwinkle, the gross profit was 20,000 and the revenue was 80,000. For Vinca, it was 24,000 for the gross profit and the revenue was 85,000. So we are at the point where we need to work out what the gross profit is for the two companies. So 20,000 over 80,000 by 100, how much you gonna get there? Check down your calculators for me. $20,000 over 80,000 by 100. So that's a quarter, right? 2 into 8 is 4. You get 1 on top. So this is 25%. and we have 24,000 over 85,000. That's going to give us, we could approximate here this to be 28.2%.
Yes, I got 28.
20.2, lovely. Return on investment. So return on investment, similar to return on capital employed, but that's not the actual formula. So I'm writing the return on investment formula. So basically, the return on investment is your net profit over your capital by 100. Right? Net profit over your capital by 100. Just pretty much the same thing now we're doing here, right? So net profit over your capital multiplied by 100. So the net profit for Periwinkle would be our gross profit minus our total expenses. So we could adjust that a little bit here. So you don't know. We gotta work out our net profit. 20,000 minus 10,000. And the capital was 50,000 for Periwinkle. For Winkle Limited, 24,000 minus 12,000, and the capital was 72,000. So 24,000.
I have a question.
Mm-hmm.
So for return on investment, I see that we have
Return on
gross profit
capital employed.
per, well, yeah.
Mhm.
I see that it have gross profit minus expenses over capital.
Mhm.
I cannot forget the reason as to why that is, because I mean, I think in gross profit would be, your revenue minus your expenses.
Right. So what you need is the net profit. Basically, your return, if you look at the name of the formula, what is the return on the investment? The return on the investment will have to be whatever net profit or net income you had compared with your investment. Another word for investment would have to be capital. Now, if we look at the set of figures that we have here, nowhere here we are seeing net income or net profit. So it means that we have to calculate it. Now, net profit is found by taking our gross profit and subtracting our total expenses from. All right, this is how we find net profit. So we have to adjust our formula accordingly because we do have a net profit figure to put here. So we would use gross profit minus our expenses. So we could find out what our net profit is and then divide it by our investment, which is the capital, and multiply by 100. And that'll give us the percentage return on our investment. Make sense?
Yes, sir.
Right? So 1/5, this will be a 20% return. And 12,000 divided by 72. This is roughly a 16.7% return if you check down your calculator. Everybody okay with that?
Yes, sir.
Okay. State which of the two businesses has the better profitability position.
Kind of like, I came in, like, I literally just sat down and I'm a little bit lost.
Okay. So let's look at the question from the top. So Floral Bloom's company is planning to invest in another business and is presented with data for its consideration for two similar businesses which operated in the same financial period. Table 1 shows the balances for the two businesses. So we have a number of accounts here: revenue, which is the sales figure, gross profit, expenses, capital, closing inventory, accounts receivable, bank accounts payable. And these are the figures that relate to these accounts for the two separate businesses, Periwinkle Inc. and Winkle Limited. Now, this company, Floral Blooms, wants to invest in another company. So it will make sense that they look at the financial standings of the company before they invest in it. We are asked in the first part of the question to calculate the ratios for each business, the gross profit ratio and the return on investment ratio. This is the answer sheet that was provided on the past paper for us to use in order to calculate that. The first part is asking us to state what the formula is, and then we have to show our working for this particular formula, for this particular ratio, gross profit, for the two companies, Periwinkle Inc. and Winkle Inc. So here I am basically stating what my formula is. Then I am going to the list of balances and getting the information and plugging it into the formula so I can calculate what the gross profit is for each company. The return on investment, right, is found by taking the total income, the net income, and dividing by the investment, right? The investment in this case is the capital. Now, our net income is not exclusively provided in the list of balances, but we could calculate the net profit by using gross profit on total expenses. If we subtract our total expenses from our gross profit, the result would be net profit or net income. So for our second ratio that we must calculate, we are taking gross profit minus the expenses, which is our net profit, and we are dividing that by the capital. So for Periwinkle, the gross profit was 20,000, the expenses was 10. So we did 20 take away 10 over the total investment. The total investment, the capital was 50,000. Right? So we already work out to be 10,000 over 50,000 by 100, and that's 20%. For Winkle Limited, the gross profit was 24,000 and the capital investment was 72,000. So 24,000 minus the expenses are 12 will leave us with 12,000 over 72,000. And when we work that out, we should get 16.7%. Right? So this first question was on ratios.
Yeah, I understand now.
Yeah. So the question continues. Part 3 is asking us to state which of the two businesses has the better profitability position. Use the calculations in A to justify your response. So let's compare. Which has the better profitability position? Are you going to go with Periwinkle Inc. or are you going to go with Winkle Limited?
Winkle.
Right. Which one you're going to go with, Navin? Now, you have to be able to justify a response, right?
Yeah, I would say the same there, Winkle.
Winkle.
Okay.
All right. So, why would you guys say Winkle Limited?
I would say Winkle because it's for 3.2% more profitable than Periwinkle Inc.
And what about this other ratio down at the bottom here? Because both are profitability ratios. Gross profit is just looking at the profit that you made on sales. And your return on investment is looking holistically. This is after you deduct all your other expenses from the gross profit and compare that against the money that you invested. So your total return on investment for Periwinkle is a 20% return. So you put out $50,000 in capital and you receive 20% on that, right? Which would mean basically you're getting $20 on every $100 you invested in Periwinkle. Whereas in Winkle Limited, you put out $72,000 and you got a return on investment of 16.7%, which works out basically to that for every $100 you invested in Winkle, you got $16.70 back. So based on what I explained there, what do you still think that Winkle Limited is a better company in terms of profitability position?
No?
No. Why is that?
Yeah, that's it.
Change your mind.
Yes, sir. Yeah. That, like basically, so Although Vinca, is more profitable, if you're checking it from gross profits, but
Right.
they might be making a little bit more with the gross profits. However, with the return on investment, they're making like a little less. So like overall, what's the name of this periwinkle? They're a little better overall.
Yeah. Right. So gross profit percentage, basically, when you are interpreting gross profit percentage, you are thinking about the profit made on every $100 of sales. Remember, this is a percentage. Percentage is out of 100. When you're looking at return on investment, you're looking at your return on every $100 of capital invested. So although Vinca is showing that they're making a higher return on every $100 worth of sales, they're dropping or falling short by the time they get to the return on investment. Their net profit is based, or the return on investment is showing that their operating expenses is reducing that large amount of profit that they have made on sales, right? Whereas with Periwinkle Limited, they have, yes, they may have 3.2% less profit on sales, but they are operating more efficiently because they are able to make $200, right? On every, or 20%, sorry, $20 on every $100 of capital. Yeah? So let's put that into words for 3 marks. So we could start off by saying we want 3 sentences. Periwinkle. I think I'm spelling that correctly. Yes, I am. Periwinkle has a better profitability position. So you take your stance. That is more 1 mark thing. Now I'm going to justify your response. Although Periwinkle has a lower gross profit percentage, I could put it here, 25%? Yeah, 25%. Split another problem. Then Vinca had 28.2. Periwinkle's return on investment was higher. This shows for every $100, because this percent is out of 100, invested in Periwinkle, a return of $20 was gained in comparison to $16.70 in Vinca. You understand how I get the $16.70? I just multiplying these by shift, adding in basically a 0.00, change it to dollars. Right? So for future reference, questions would change. Right? They would change. You'll have a different company, you'll have different figures, you'll be looking at calculating different percentages. But your key takeaway here for me today is that I want you to understand for these percentage ratios, You're basically looking at, if you're comparing gross profit to sales, you're looking at the gross profit made on every $100 worth of sales. Here, if you're looking at return on investment, you're looking at the return or the net income made on every $100 of capital. So you could compare the two companies from that particular standpoint. Does that make sense to everybody? And when you're explaining your comparison or justifying your reason for going with a particular course of action or selecting one over the other, you'll use that in your explanation. Yeah?
Yes, sir.
Right. Identify one ratio which Floral Bloom's company may use to calculate the liquidity position of our business. What ratios we have at our disposal? This is our list of ratios here that we could use for liquidity. Anybody remembers?
Inventory turnover.
Liquidity. When we talk about the liquidity of our business, what are we talking about?
How fast you can turn it in the cash flow?
Yeah, but when we're talking ratios, it's a little bit more than that. So the order of liquidity is how fast you can convert it to cash. But when you're talking about ratios and we're talking about liquidity ratios, you're looking at something else.
What percent of it is easily convertible?
Nah.
Wait, I kind of forget that. I'm so sorry.
It had to do with the current ratio and the asset test ratio.
But I see here, the asset test ratio.
And the current ratio. Anybody remember what those two ratios is checked? Look at the things inside of it.
What percent of it is actually not sure.
So remember we was talking about working capital and the ability of our business to cover or meet its short-term objectives, short-term debt obligations, was the word that I use.
Oh yes. That's
Right,
it.
right. That's when we're talking about the liquidity of our firm. Liquidity ratios, they examine the ability of a firm to meet its short-term debt obligations. Right? And I think I'd give you an example of this person going out to rent and the rent is more than what they, or very close to what the salary is. You remember that example? And when by the time they pay the rent, they don't have any money remaining to do other things. Right? A business needs to make sure that its current assets could cover its current liabilities at least 2 times. 1 time is too short. I'll use the example of the rent. And if you just have enough money to pay the rent and then buy the groceries, anything else happen after that, you don't have any money and you find yourself in a very difficult position. Worse yet, if you only have enough money to cover your rent and nothing else, right? Which is a similar or modeling what we were talking about that could happen with our business. Liquidity ratios examines the ability of the firm to meet its short-term debt obligations. All the current liabilities. Current liabilities would include things like its creditors and other debt obligations, right? If you do not have enough to cover, then the company runs the risk of running into financial issues, right? Cash flow problems, wouldn't be able to pay certain things, and eventually the company could become what we refer to as being solvent. right? Unable to meet its debt obligations. So there are two ratios that looks or calculates liquidity. One of them is the current ratio. And the other one, which is a bit more robust than the current ratio, is the acid test ratio. Right? Acid test ratio. So state the formula for calculating the ratio advertising in B. Right? You have current ratio and you have acid test ratio. Which one you want to use? Which one you want to try?
So we can try the asset test.
Or do the acid test, right? But we have to make sure we have all the information to do the acid test, right? So as in closing inventory, we need that. And we had to work out our current assets. So our current assets is made up of, we have inventory, bank, and receivables. These three things is current assets. But if you're doing the asset test ratio, you do not include the inventory. So you'll only be taking accounts receivable and bank. Right? Now the formula for your asset test it's usually your total current assets minus your inventory, or just omit the inventory, and you divide that by your current liabilities. Current liabilities would include any accruals or any payments you have to creditors. Your account payables. Your current ratio takes the full figure for current assets. All right, so the whole word here, right? So it includes the inventory. All of your current assets divided by your current liabilities. Now the answer you get is usually expressed as the whatever number you get here to 1 as a ratio. Right? Hence the word ratio here. So what it tells you is the number of times that your current assets could cover the current liabilities. So based on the figures that we have here from Periwinkle, right? Our accounts receivable is 25,000 and our bank is 7,000. We're not going to include the closing inventory because closing inventory is not included as part of the current assets when you do the asset test. So 25 on 7 is 32,000. And you put that over your total current liabilities. In this question, we only have one, which is our accounts payable, $15,000. So you can work out that for me. So we had to do that for the two companies, right? So this is for Periwinkle. I'll just put a P here. And on this side here, we're going to put for Vinca. Vinca has accounts receivables at 20 and bank at 8 and 10. So 28 over 10. You'll have a figure there for me.
32 over 15, yes, sir.
What we have for this one.
So I got 2.12.
Right, so we could use 2.13. We could put it as 2.1 to 1. What about this one? $28,000 divided by 10,000.
Yeah.
2.8, right? So basically what we're saying here is that for Periwinkle, they could meet their short-term debt obligations 2.1 times. They could pay all of the current liabilities out 2.1 times. That's not bad. That's good actually. And Vinca could cover this 2.8 times, right? So that means the likelihood of the company itself running into cash flow problems where it can't cover its current liabilities. So both Periwinkle and Vinca is not likely. Yeah?
Yes, sir.
So
So
you,
both of them unique.
uh,
So both of
yes.
them is unique.
Yes, we would say that they are solvent, meaning that they can meet debt or debt obligations. When they cannot, insolvent is the word we'll use. Right? Those are the opposite same. So these are words that you need to make a little note of, because for this topic, when you're explaining things like this, this is the type of vocabulary that you have to use. Now let's look at the current ratio. The current ratio, we're just going to use the full current assets figure. So that means that we would not exclude the inventory, but include the inventory. Now, what that's going to do is it's going to increase that figure that we had there, right? This is why some people tend to prefer to use the asset test ratio as opposed to the current ratio, because it gives a more realistic picture. Reason being, inventory is something that is not as easily converted into cash. And that's where the liquid part that you was talking about earlier on, Navin, comes into play, right? The debtors and the bank figure are more quickly converted into cash or more liquid than inventory. So sometimes a company might have a high current ratio, and then when we remove inventory from out of the picture to the asset test ratio, it shows that they're not as liquid as we thought they was. They're not as solvent as we thought they was, right? Because a lot of this stuff was being padded by the inventory. So you could use the asset test ratio for a better picture, a clearer view in terms of the business's liquidity. Make sense? Right. So we already know that this was 32,000. So if I add a 13 to this, that'll give me 45,000, right? And nothing will happen to the amount of current liabilities. That pretty much remains the same. So now we have 45,000, this is for Periwinkle, over 15,000, and that's going to give me a 3-to-1 ratio. Yeah? And then for Vinca, we already have 28, so if we add 17,500, how much we getting there? 45,500. Right? And nothing's going to change in terms of the current liabilities. So we get in, as I mentioned, a bigger number than before, 4.55. So what? Right? Now, you don't want too big of a figure, right? 2, 2.8, 2.1, that's good. From the time we start to look at 3 and bigger, we would say that the company, if the current ratio is too high, When I say too high, I'm talking like 3 or greater. They say that the company is not making full use of the cash in order to expand and develop the business. Does that sound familiar? You must say something like that before, right? You have the extra money, but you just have it sitting. The term that I may have used is that they have too much idle cash or current assets. That could be put to use in the business to buy more things, to expand assets, to expand the business, to improve the efficiency of the business. Understand? So you don't want it to be too high. 2.1 is ideal. 2.8 is all right as well too. The 3 and the 4.5, 4.5 is pushing it. The 2.8 might be pushing it a little bit too. But we could live with the 2.8. Right? It gives us a little buffer area. But this 4.5 is too much. Yeah? Everybody understand that? Use appropriate figures from table 1 to calculate liquidity position for each business. And that's what we did here, right? So I don't need to do this over. Maybe I should just cut these out from here and put it down. So let's see. Asset test ratio is what we use, right? Okay, everybody good so far? Everybody understand? So from doing this question, you should have a good understanding of gross profit ratio, return on investment ratio, liquidity ratios, current and asset test ratio. Everybody all right?
Yes, sir.
Right? So my answer here,
Further, you could go over the asset test ratio.
right? So the asset test ratio was the formula. Remember the formula?
Current assets over current liabilities.
That's current ratio. Asset test is your current assets without the inventory.
Oh.
And you're putting that over the current liability. So the only difference is that you're not including the inventory with the asset test ratio. Yeah? Now, when we do the asset test ratio, here they're asking us to state which of the two businesses is in a better liquidity position. Right? I would say here Vinca.
So, and we say that they also had some like assets that were not in use.
Idle cash.
Yeah, idle cash. So,
But because we're using the asset test here,
yeah.
not changing the picture. Because the idle is not cash, it's inventory. Understand? If we were to compare the two of them side by side, Finca has too much inventory on hand. Their closing inventory is too large. Look at Vinca. Vinca has a closing inventory of 17,500, which increases its total. If you look at the two ratios, it increases it by a substantial amount, nearly two more. Almost 2 times more. Right? Or 3/4 times more. If you look at it with the current asset test ratio versus the current ratio. See now? But because in this part of the question, let's just assume that we only use one, which was the asset test. And that's what the working I put here. If I have to choose between the two, the better liquidity position would be Vinca. Vinca is a better position. Even after you remove the inventory, it could still cover its current liabilities 2.8 times. To put that into context for you, right? If you are living on your own, you start working and leave your parents' house, and you have to rent on your own, cover all your expenses, do your groceries, whatever, right? Would you prefer to be in a position where you're earning a salary that you could cover your total expenses 2.8 times or 2.1 times? Which one you'll feel more comfortable doing?
2.8 times.
2.8 times. Because if you could pay your entire salary, you pay all your bills 2.8 times, it means that really and truly, when you do it once, you still have a whole 1.8 left over that you could save and invest with. Well, you hope that that's what you'll do with it, right? So it is better, and then think about it this way. In the event of any uncertainty, Vinca is in a better position because they could cover their liabilities 2.8 times. So it makes them a bit more resistant to external changes and changes that they can't foresee or do not have any control over. Understand? Now there's a borderline. We don't want to get to 3 and 4 and 5 and 6 times. This is the point where we're going to say that you have too much idle cash around. Right? Although you're in a good liquidity position in terms of covering your current liabilities, a lot of the excess cash or current assets could be used in the business to expand the business and help generate more profits. Yeah? So let us include that here. Right? Since it can cover its current liabilities 2.8 times, some this extra liquidity can be used in expanding or improving the business. All right. On the side note here, because we did do both ratios, I'm going to say though that the current ratio for Vinca, which is 4.55, we said it was, suggests, and these are words that you need to be familiar with, I think can utilize some of these extra current assets more efficiently to improve business. Improve or expand the business. Yeah? Are we okay with that?
Yes, sir.
So that's ratios. So you all should be prepped for ratios for any term exam. Anything on current ratio, asset test ratio, gross profit, return on investment, it should be good. Yeah? All right, so we're going on. This other question is looking at your ability to enter into a ledger, right? So you have a good bit of entering to do here. Bobby, a sole proprietor, presented the following list of transactions for the month of May 20, 26, 23. All right? The owner made a bank deposit from his personal resources. What two accounts would be affected by this? So this is double entry record in the unit. Made a bank deposit from his personal resources. What is he introducing into the business?
So you're introducing capital into your business.
That's correct. So what's the double entry for this? Bank is going up because he's making a bank deposit.
Yeah.
And
So yeah, your debit bank and your credit.
good.
Yeah.
So you're gonna write here bank account. And this is May 1st, 2023. Capital 75,000. And the other account involved is a capital account. Right, May 1st. Bank 75,000. Yeah. Next, withdrew cash from the bank for business use. We're going on there now. He's taking money out of the bank for business use, not for personal use, for business use. So what is happening there? What is going down?
So well, yeah, the way down.
That's all right. I must still explain it.
Right. Well, you're taking money, hence you're crediting it. You're taking money out of the bank and coming out in cash. So they increase the amount of cash. So
Correct. So we actually going into the bank account here, and this is on what date? May 6th. So you're gonna credit bank because remember on this side is in, on this side is
But the capital was always credited. But how come capital is debited?
Which one is the capital account?
The second one.
Which side is which side is credited?
The right side. Then that's in bank is being credited.
So this is what is right in the middle here?
I'm so confused now.
What's the name of this account?
Capital account.
On which side we writing on the capital account?
Credit side.
Right. And what this is telling me?
The bank account.
That's where the money is coming from.
But shouldn't the bank be debited? So why is it not on the debit side?
So this one here is which account?
Bank account.
Right. And what side we writing on here?
The debit side.
Right.
But the capital is literally on the debit side.
But is this the name of the account?
No, but then why is it still on the debit side?
So if I do write this here, if I take these things out, where does money come from? Or where is it going to? Where did this $75,000 come from? We write 75,000 in capital account. Where is the 75,000 coming from?
The bank.
All right. So if I do this, where is it coming from now?
Somewhat.
Why do we write something inside of here? This detail is telling us what?
The account where the money is coming from.
Exactly. So are we debiting this account that we write in here or crediting this account we write in here? Or are we crediting the capital account?
Crediting the capital account.
Right. And do we need to write the name of the other account involved in the details?
Yeah.
Right. And what is the name of the other account involved here?
Bank.
All right. So by writing bank here, am I crediting bank?
No.
What are crediting?
Capital.
Right. So when I write bank here, which side am I going to write on?
Debit side.
Right. And what's the amount that we're writing on? How much is it?
75,000.
And what are we going to put here?
Capital.
Good. So by writing capital here, am I debiting the capital account?
No.
Understand it better now?
Oh my gosh.
No, you gotta tell me yes or no. It's either you understand it or you don't understand it. Because I don't
But
take
the teacher is the exact opposite thing that she taught.
was the opposite.
When we were doing it, like that's the example I've been going over. When you're crediting something, it stays on the credit side. Like you write it on the credit side.
Right.
And if you're debiting something, it goes on the side with the debit.
Right. So if we're crediting capital, this is the credit side, yes?
Yeah.
Right. So this is the credit side. So did we credit the capital account? We credit the capital account?
Yeah.
Yes, you sure?
Yeah.
And how are you determining if you credit the capital account?
Okay. No.
Huh?
It's on the credit side.
Right, because you wrote on the credit side. And are we debiting the bank account here?
Yeah.
Right? How we know we debiting the bank account?
Because you wrote on the debit side.
Exactly. We wrote on the debit side. Does this have anything to do with it?
No.
No. This is your details. Remember with the double entry system of accounting, every transaction has or affects two accounts. The details, which is the middle column you're writing here, is not the debit or credit. The side you're writing on is a debit or credit. The details is telling you where to look for the other half of the transaction. So if you are debiting your bank account, it wouldn't make sense for me to write bank here. Because then, what's the other half? We are checking for it. Because then I'm just staring into the bank account alone. So I have to write the name of the other account. If this is the debit entry, basically by writing capital here, it's telling me where to find the credit entry. And by writing bank here, it's telling me where to find the debit entry. Understand? This is the account name. This is the account that is being debited or credited. The name of the other account involved is what is going here.
Okay.
You can't put back the same name here. You're already writing in the bank account or you're already writing in the capital account. So if I write in the bank account and the details, I need to write the name of the other account that is involved. Clear now?
Yeah.
Sure.
Yeah.
All right. I gotta remember that, all right? Well, we reinforce that because everything here is debit and credit. This whole question. Right? Everybody understand that, right? We good with that. Usually there's a area of confusion at the start of double entry accounting. That's not uncommon, right? Because we see in debit, but then you see in capital here. The capital here is not the name of the account. The name of the account is what you put into the top, right? So similarly, in that second transaction we talk about up here, where we withdrew cash from the bank for business use, we are literally taking money out of the bank, and I like to write out and in for the cash and bank account, and we are putting it in our cash account. Right, so this is in, this is out. So this is May 6. What I'm gonna write here? Jail. In the cash account, so what I have to write here? Where's the money coming from?
The bank.
Right. Am I debiting the cash account here?
Yeah.
Yes, because money is coming into cash. And I am debiting it for $4,000. So basically, it's like, okay, we need to have some cash in the office in order to handle whatever expenses we need to pay in cash. So we're taking $4,000 out of the bank and keeping that as cash in the office. So May 6, I'm taking money out of the bank. Where is it going? It is going in cash. How much is it? It is a total of $4,000. Everybody clear now? May 8, proceeds of sales for the week are banked. So this is sales and bank. So you're identifying the accounts, and then you need to identify increases and decreases. Sales is increasing, yes? And bank is increasing. Agreed? So if we bank sales, what are we going to do with bank? Bank is going to do what? It's going up. Debit or credit?
So you can repeat it?
Are we gonna, I'm trying to work out debit or credit for the accounts. So am I going to debit or credit the bank? Money is coming in because I'm going to debit it. Why am I debiting it? Because it is increasing and it's an asset. So if I'm debiting bank, every double entry has to have a debit and a credit. Agreed? Yes?
Yes, sir.
Right. So it means that sales is going to be what?
So it means that sales will be increasing.
Right. And what entry we going to use? Is it going to be a debit or credit?
So the sales are
For the sales. Yeah, for sales. We're going to debit sales or credit sales?
we're gonna credit sales, so
Right. Why? Because every entry, every transaction, one account is being debited and the other account has to be credited. So if we are already debiting bank because the money is going into the bank and causing the bank to increase, and we know for certain that an increase in the bank means that we have to debit the bank account, it will only be logical that the sales have to be credited, right? An increase in sales is credited because sales is tracking inventory. When I sell inventory, the asset of inventory is actually decreasing, and that's why the sales account is always credited. Now, that's a confusing way to look at it. Not everybody might grasp that. So it is easier when you have a transaction involving money to follow the money first. Because if you could identify what is happening in the bank or cash account, it means that the other account is doing the opposite. If I am debiting the bank, it means that I have to credit the sales, because every debit has to have a matching and corresponding credit. You cannot have two debits and two credits. One account will be debited, one account will be credited. So we already have a bank account here. This is the 8th of May, May 8th. We're going to debit bank, and look at what I write in here. Sales. I'm not debiting sales, I'm debiting bank because I'm writing on the debit side. Sales is the name of the other account that is causing me to debit the bank, because I am getting this money from the proceeds of sales, so $55,000. Everybody clear on that? It means then that I need to complete this double entry. Remember, double entry means 2. So I have to open a sales account, and on that same date, May 8th, we sold $55,000 and this money was banked. So we have a debit and we have the corresponding credit. Right? Bank is the word that we use, right? Not banked. Good so far? All right, so we're going again. We use a check to purchase a used delivery van with extra spare parts. Use our delivery van and spare parts account. Use a delivery and spare parts account. 24,800. Right? So we're not separating it. We're just going to use a delivery van and spare parts account. One account for both of them. Right? How are we paying for this delivery van and spare parts?
By check, so bank.
Right. What we're going to do with the bank though? Debit or credit the bank?
Credit.
Credit. And the reason we're doing that is because we are decreasing the money in the bank. Very good. So that means what am I going to do with this van and spare part account? If we already have a credit here.
You debit it.
Exactly. See how to work it out? So always follow the money. The money, once the transaction involves money, that's an easy transaction to work out. Right? Easy to work out. Because you could quickly identify if you're going to be debiting or crediting the bank, or if it involves cash, if you're debiting or crediting the cash. And once you work out one half, the other half had to be the opposite. So we go in our bank account, 24,800. This is May 9th. So I come in here, May 9th, 24,800. And in the middle here, I write in the name of the other account. So we put in delivery van. And they say use that on spare parts account. I don't know where they want to fit all of that, but you'll see how we fit. And then we open another account for delivery van. And spare parts. I'll be writing on this side, May 9th. Bank. 24,800. Yeah? You okay with that one now? So we always want to make sure we have our matching debit and credit. All right. We bought inventory now on credit from Rob Smith. The terms is 510 net 30. What does that? Anybody know what 5/10 net 30 means?
There is when sales go up, when sales go up, you credit it, and then when bank goes up, you debit it.
When
Right?
sales go up, sales is always credited all the time.
Okay.
And purchases is always debited all the time. So sales, anytime you hear sales, you always write it on the credit side of our sales account. Anytime you hear purchases, you always write it on the debit side of our purchase account. Right? This is a piece of jargon here. That a lot of people just get tripped up by. 5/10 net 30. What does that mean? It means that you get 5% discount if you pay this debt or pay this off in 10 days. And you have a maximum of 30 days credit. So you have 30 days to clear this bill. If you pay it off in 10 days, you'll get 5% off. If you don't pay it off in the 10 days, then, well, you pay the full amount, full 17,000. Now, he's buying this on credit. So does this involve any bank or cash? If I buy something on credit, am I paying for it?
No.
No, I'm not paying for it now. So if I'm not paying for it now, then I should take the name of the person that I owe, right? So I'll know who had to pay, agreed? So for this transaction, it involves Rob Smith, because he takes something on credit from this man, and this is inventory, agreed? What account do we record inventory in?
Purchases, sir.
Purchases, that's correct. And what do we do with purchases? We always do what? We always?
Debited.
Right. And Mr. Rob, right, because you're buying goods. And Mr. Rob Smith is called a
Account payable.
account payable, yes, or creditor, that's correct. Account payable or creditor, right? So creditors will obviously be what? We debit, right, credited, right? Because we debiting our purchases, and a creditor or accounts payable is a liability, and we are increasing this liability, so we credit it. Purchases is an asset. We are increasing that asset, so we debit it. So we need to open a purchases account. Now, purchases account is only for goods or stock or inventory, not for a delivery van, unless you're selling delivery vans. It doesn't seem as though this person, Mr. Bailey or whoever, is Bobby, selling delivery vans, right? This is May 12th. So May 12th, we write in our purchases account. What would we put here? Who did we purchase on credit from?
Oh, we purchased from Rob Smith.
Rob Smith. So that's the name that has to go here. Rob Smith. So inside of this purchases account or purchases ledger, you're going to have all of your creditors, right? Now we're gonna write here now Rob Smith, and we'll put May 12th, and we'll write purchases, and we'll put our 17,000 in. See it? Everybody good with that? Now we have the opposite happening here now. We have sales. We sell an inventory on credit, and our terms is 210. So that means 2% off if you pay it in 10 days, and you have a total of 30 days to pay. Who we selling this to? So, S. Peters. So this is sales, and it is on credit, so we need to keep the name of the person so we know who to check for our money. S. Peters. So sales is always what? If purchases is always debited, sales is always
Credited.
credited. And if we credit in sales, what we going to do to S. Peters?
Debited.
Debit. And he is a accounts receivables, right, Navin? Or if you owe like me, you will say he's a debtor.
Yes, sir.
Right? Right, it's on.
So,
Yeah.
when you say that, right, they really used to just call it that alone, okay?
Yeah. That's it.
So when accounts receivables come about,
I don't know. I guess they always use. I knew both of them. I knew both of them because in the exams and stuff, it will come as accounts receivables and accounts debtors. and accounts payables. I had to know both of them to write CXC, right? But they used to be used interchangeably, and I guess as time went by, people just stopped using the debtors and creditors, teachers that is. Maybe because what was the jargon more frequently used in exams was accounts payables and accounts receivables. And if in class you're continuously talking about debtors and creditors, the students probably used to get confused when they see payables and receivables and don't know what are receivables and payables is. Right?
They just started to use
They just
receivables and payables more.
they just start to use that alone instead of debtors and creditors. But
it's kind of like how they had center back and stopper back in the day.
yeah, right. Yes.
Yeah.
Yeah.
They
Center
don't
back
call
on.
nobody stopper.
No. What is call them now?
Nah, they just call them center back.
Center back, right? Before too, we used to call them sweepers.
What's that? Yeah, that was real before my time.
Yeah, sweepers. So they would play the two stoppers and play sweeper, a sweeping position. Yeah. Right?
My grandpa was the only one who knew about stopper in my family. That's a sweeper I didn't even hear about.
Yeah. Stoppers or sweepers, yeah. That's pretty much what they would call them. I say they had fellas like Maldini and Nesta and thing playing the back there.
Anytime you call, but actually I shouldn't say that because Maldini I look up to him, but you know.
Yeah. All right. So we okay with this, right? Everybody understand the flow with this so far? Yeah? All right. So let's look at this one. Cash sales now. Did we write this entry? No, we didn't write this entry as yet. I'm right. So we had to write sales. Now sales, you'd always see entries in our sales account on the credit side. Made $39,000 as and the name of this account will be S. Peters, May 13th. And he's a debtor. That's why he writes it on the debit side. Jelly, you're a little more comfortable now with this, right? It's not confusing anymore with the.
Yes, it's way better.
Right.
I don't know what the teacher was teaching.
Yeah, just keep it like that so you don't get confused. Right? Remember the account is what is being debited or credited. In the middle there is just your details to tell you who's the other person involved.
To help me, I've been thinking like if the business's money is going up, then wait, what was I thinking? Never mind.
Well, with money, if anytime money coming in or increasing your debit. But it's better instead of think about it like that. Just need to identify half of your transaction all the time. But that's how I would approach it. So for example, this May 15 transaction, cash sales. What do we know about sales? Sales is always
Credited.
Exactly. Was the other thing involved?
Cash.
So cash has to be right. See how simple to keep it? Keep it simple. When we start to apply too much rules and stuff, that's where it started to get complicated. Right? So we're keeping it simple. Sales always had to be credited, so it means the other thing have to be debited. So we come in our same sales account. And we're gonna write cash. How much is it? 3,600. And we're supposed to have a cash account somewhere, right? Right here. Sales. 3,600. Just get the dates. 15th, May 15th. I think I have two sales accounts. I have an next sales account down here. Think you could do that and happen? Right side of your problem, see.
They mean to.
Now see 15th. on the whiteboard there are real problems that are going to rub off and throw back. All right, so we do that. And we can move this whole fella here.
Good. Well, I think this is bad with the double entry. I tell my teacher, no, this was when we first started the general journal, and I had get it wrong because I didn't really understand what she wanted from me from the narration because that lady, like, she didn't explain it to me too good.
Yeah.
So tell me why I decided to jumble up the narration and thing. And he was like, yeah, come on the board. And I had to do out a whole general journal on the board. I spent it 2 periods. Normal. And the question was long. I don't know how much transaction they want to have in 1 month.
Some of them transactions is long. This one was a long one too. I was surprised they had something like this in an exam. Because it takes time to do this. You're almost done though. You know, reach this one. 18. Paid cash for petrol and servicing of delivery van. Right? So we have cash. If I pay in cash, we're gonna do it in debit or credit?
Credit.
Credit. And we could just coin all of this as motor van expenses or delivery van expenses. So we will debit our delivery van account, $800, right? Delivery van expense account. So this is the 18th. $800. Benefit. Cash. Okay, look for my cash. Yeah. Settle account with Rob Smith in full by check. Now this is where it get tricky. Rob Smith was where? 12th. What's the date we're going to pay him? The 21st. So let's do a quick little timeline. 12, 13, 14, 15, 16, 17, 18th, 19th, 20th, 21st. How much days is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 5% off if we pay it in 10 days. Exact 10 days. Yes? Everybody agree with that? Or you could even start counting from the 13th, right? Because they buy it on the 12th. So we get any 5% off. That's the point I'm trying to make. We okay with that part, right? So we had to do some work in it. So we're gonna pay, we're getting 5% off. So we're not paying 100% of this. We're only paying 95% of 17,000. Make sense?
Sorry, for the May 18th, that one would have been under van spare parts accounts, van and spare parts account, right?
No, I open a separate account for delivery van expenses. Yeah. Because that was more travel and servicing. It's not really spare parts or delivery van. So it has a delivery van expense account. So if you want, you could use motor expenses. That's a good account to use as well too.
And you credited cash.
Cash, yes, credited cash. So for this transaction, where we settle in this guy, we actually paying him 16,150, right? And the difference is our discount received. So this is the amount paid. So we have three things going on happen here. We're paying this by bank. So we have to credit this. We're also going to credit discount receive credit for the amount that we didn't have to pay, which was $850. And we have to debit his account for the 17,000. Now, we split it up there too, right? So we're gonna debit him twice. We're gonna debit for the 16,150, and we're also going to debit for the 850. So I'm gonna show you how that looking, right? We have our bank account already. We have his account already. We need a discount receive account. Going to Rob Smith account. Where Rob Smith? Right. So you see this $17,000, it breaking up into 16,150 and 850. To clear up when you add these two things together, that's how you get is 17,000. This 16,150 is what you're paying by bank, and this 850 is the discount you receive for paying in 10 days. So I'm balancing off there. Make sense? Everybody understand now? Yes? So it means that I have two accounts that I need to write in. Bank. It was it, 21st. Rob Smith. And 16,150. And I'm going to discount receive. And on the credit side as well. All right, Rob Smith. I put the 850. Cool? All right, so I'm done with this. Paid cash for miscellaneous business expenses. So this is going to be a debit to business expenses and a credit to cash. 1,900 on the 25th of it. Right, and we open our business expenses account. Now, all expense accounts are always debited. Yeah? You okay with that transaction? Bobby, which is the owner, paid his home insurance. Is this part of the business? No. So this is an example of what we refer to as drawings. So you're taking this out of cash and you're going to have to open a drawings account. And this is happening on the 26th. So May 26th, he's drawing money out of the business to pay his personal expenses, 2,500. So you open a drawings account. I'll be right here, May 26, cash 2,500. Yeah? You okay with that, right? Settled the business's electricity bill by check. So our bank has to be credited because you're paying the bank and you're going to debit electricity. 27,500. Ask, well, I was going to say, expense accounts are always debited. right? Because in order to pay the expense, you have to be crediting your bank or your cash. 28. S. Peters settled his account in full by check. So S. Peters had 2% if he paid in 10 days. So if we check 14th, 15th, 16th, 17th, 18th, 19th, 20th, 21st, 26th, 27th, and he's now on the 28th. So he kind of missed it, right? Agreed? Yeah, right, stop. 14th, 15th, 16th, 17th, 18th, 19th, 20th, 21st, 22nd, 23rd, 24th, 25th, 26th, 27th, 28th. So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, he didn't get through. He didn't get no discount. Right? Because look how long after he paid. Agreed? Everybody agree with that, right? So Mr. Peters, he bought goods on credit from us. And he had 30 days to pay. He did pay the 30 days, but he had to pay the $9,000. And he paid by check. Right? So that's the 28th. Huh?
I see, sir. I see. And he paid by check too.
And he paid by check too. So we had to wait for that check to clear. So he had to pay his full $9,000. So Peters, he had to go and find his account. And he had to come here. For bank. 9,000. Yeah? Everybody feeling a little more comfortable with this now? Owner made a bank withdrawal for personal use, May 29th. That's another drawing.
So I posted this thing.
Yeah, it's recording, and I'm gonna download this because we still have a good bit more questions for us to look at. This is supposed to prep you for the term exam because every question is on a different topic. All right, so I recorded it so you can look over the recording and you're gonna have the solutions as well. On the 31st, we received total 1,200 cash from the sale of some old van spare parts and realized a profit of $200 on the sale. Right? So just have a couple of things going on in it. We're gonna get cash. So we debit in cash for $1,200. But we also gonna have to we have to have something called a disposal account. Spare parts. In the disposal account, there is a profit on disposal, right, of $200. And if you made a profit of $200, it means that the original cost of the item, spare parts, had to have been 1,000 in order for me to make a profit. Everybody follow that logic? That makes sense? If I make up, yeah, you good with that, right? Good. Now I need to create another account called disposal spare parts. Now before I could use this, I need to transfer the spare parts from our asset account across. So I'm gonna credit this because I'm decreasing it. And we'll put here disposal spare parts.
So will we be balancing these accounts?
I don't think they'd ask for us to.
No, but like, can we balance?
Yeah, you could balance them for practice. That'll be good practice.
Can you teach me how to balance?
To balance them, yeah. I don't know if you have time to do it because we're already almost at 7. And we had to wrap up just now, but you could do that. Disposal, right? So let me just wrap up this one really fast here. we need to move it $1,000 out of the delivery van and spare parts account because we're reducing the sale because we're selling it. Now we move it. So we move it into the disposal account, $1,000. Then we need to deal with the cash. I am getting on May 31st, sale of spare parts, $1,200. I get in cash. So I recording that here and I'll go to my disposal account and I'll credit it because I just debit you also debit the cash account, right? So I put cash 1,200. Now, if you look at this side has 12, this side has 1,000. So I'm gonna write here profit on disposal 200. That's how this is gonna match up with the $1,200 and reconcile the difference between the cost of the spare parts and the profit that I made on the sale. Everybody all right with that? So it's not a straightforward one debit, one credit. It involves us opening a separate. Every time we dispose of an asset, we have to open what we call a disposal account because we're taking part of the asset out to get rid of it. So you take it out at cost, you debit or credit, you always debit in your cash or your bank because you're receiving money. And then you will credit the disposal account, and then you'll be able to determine whether you made a profit on the disposal or a loss on the disposal. This is usually added to your gross profit if it's a profit on disposal. If it's a loss, it's subtracted as an expense. Yeah? Now, quickly, just to refresh your memory, to balance the accounts, you need to add both columns. So if you look at our bank account and I add the total of my debit column, 75,000 plus 55 plus 9,000. That works out to be a total of 139,000. And then I add up the opposite side as well. 4,000 plus 24,800 plus 16,150 plus 500 plus 5,000. This works out to be 50,450. The side that has a smaller amount, we want to ideally get both sides when in balancing our account. We want both to be the same. We want this. Currently, we can't get this because this side is short. Look at how much you have here. So what we need to do is we write a balancing figure. Our balance carry down is the difference between 139,000 and this 50,450. Understand? So our balancing figure is $88,550. And that's going to allow us to get both sides to balance. It also means that at the start of the new month, when I go on to June 1st, I will be starting that month with a balance brought forward of 88,550. To show that our account is balanced, we usually use double lines. Yeah?